All right, Morgan, we've talked about workers, we've talked about babies, we even talked about tips, but now we're talking about your people.
Entrepreneurs, business owners, startup founders, this one's for you. If you've ever asked yourself as a business owner, I'll just write it off, you might actually want to understand what that really means now.
Today's episode is packed. Deductions, real estate planning, and the kind of acronyms that usually require a CPA to decode.
Luckily, we have my secret decoder with us, so we'll be in good shape. Let's start with one that gets asked almost every year at planning meetings. QBI, Qualified Business Income.
All right, 199A, AKA the Qualified Business Income Deduction. Morgan, what did OBBBA change?
Good news for business owners, 20% QBI deduction has been made permanent. That's a huge win.
Absolutely. So if you're a sole proprietor, S-Corp owner, or in a partnership, you still get to deduct 20% of your qualified income off the top.
Exactly. And the income phase-out thresholds have expanded as well. Now it starts phasing out at $75,000 for individuals and $150,000 for joint filers.
Bottom line, if you run a business, you're keeping more of your earnings, assuming your structure is right, and you're not winging it on TurboTax.
Okay, let's talk about QSBS, Qualified Small Business Stock. Jay, hit me with the update.
OBBBA makes QSBS even sweeter. Now, depending on how long you've held the stock, you get a tiered capital gains exclusion.
So it's no longer just 5 years or bust?
Nope. Here's how it works for stock issued after the bill. Hold it 3 years, you get 50% exclusion. 4 years, it's 75%. 5 years or more, you still get the full 100% tax-free gain.
And they raised the cap from 10 million to 15 million per issuer, index for inflation. Plus, the company asset threshold qualifies jumps from 50 million to 75 million.
This is a huge planning opportunity for founders, early employees, and angel investors. But remember, this only applies to C-Corps.
Translation, don't try to claim this on your Etsy side hustle LLC.
What do you have a side hustle? I need it. All right, let's shift gears. Real estate and depreciation. What's new?
100% bonus depreciation is back for qualified assets. So if you buy vehicles, equipment, even certain commercial real estate, you can write off the entire cost in year one.
And don't forget Section 179. The cap's been bumped up to 2.5 million. Combine that with cost segregation studies on properties, and the write-offs can be massive.
Absolutely, it's huge. If you own short-term rentals or commercial buildings, this is where you lean in. Not all deductions were created equal. This one potentially could increase your cash flow.
Just don't buy a building in December and forget to tell your accountant.
Okay, Jay, estate planning. What did OBBBA do?
It made the big number permanent. The estate tax exemption jumps to 15 million for per individual or 30 million for couples indexed for inflation.
And that's a major win because when you talk about dropping back down to about 7 million in 2026 if Congress did nothing.
That's right. So now, more assets can pass tax-free, whether it's real estate, business ownership, or the vacation home you swore you'd never leave to your ungrateful kids. And finally, let's talk about opportunity zones. Morgan, this program got a serious reboot.
OBBBA extends the original Qualified Opportunity Zones, QOZs, indefinitely and introduced a new twist, Qualified Rural Opportunity Zones. Now, keep in mind, most QROFs don't take effect until January 1 of 2027.
That's right. Same basic idea, reinvest capital gains into economically distressed areas and defer, reduce, or possibly eliminate taxes.
Hold it for 5 years, get a 10% capital gains reduction. 7 years, 15% reduction. 10 years, pay zero tax on the growth.
This is one of the best tools for real estate developers or investors sitting on big gains. Just make sure it fits into your overall strategy because compliance here is not DIY friendly.
All right, Jay. So what's the real message for business owners?
This bill isn't about one giant tax cut. It's about dozens of small but meaningful tools. Entity structure matters, timing matters, and who's on your planning team. That matters the most.
If you own a business, invest in startups, or want to transfer wealth efficiently, this is the time to map it out.
Because the rules are changing, but your window to act, that's already open.
That wraps up our One Big Beautiful Bill series. 4 videos, dozens of strategies, and hopefully a slightly smaller tax bill.
Subscribe, share this with someone who's building something big. And if you want help putting all this into action, reach out to us.
This is Fremont Partners, where we translate policy into planning and planning into financial freedom.
Take care.